Let's say China.
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 China. China.
China.
China.
China.
China.
China.
I love them. China.
Tariffs, trade wars, economic uncertainties. These terms have become commonplace when discussing China's current economic standing. Despite ongoing U.S. tariffs initiated under Trump's administration, including an initial dramatic escalation to 125% reciprocal tariffs, the immediate economic disruption to China appeared surprisingly limited. China's direct export to U.S. represent less than 2% of China's entire GDP, and only 10 to 20 million workers in China may be exposed to U.S.-bound exports, according to an estimate by sell-side banks. Trump's administration initially believed aggressive tariffs would pressure Chinese manufacturers significantly. However, it soon became apparent that simply piling on higher tariffs would not fundamentally alter the economic calculus for many Chinese firms. At extremely high tariff levels, be it 125%, 200%, or even 500%, the specific tariff rate matters less than the fact that trade becomes nearly unviable. Firms couldn't realistically absorb such steep increases. They either pass increased costs onto consumers or simply cancel orders entirely. But ironically, these tariffs would eventually begin to inflate prices within the U.S. market, exacerbating domestic inflation. Recognizing this counterproductive outcome, the Trump administration recently began toning down on tariffs, saying China tariffs will come down substantially on Tuesday, April 22nd. But beneath the surface lies a deeper and more complex reality. Is China truly resilient, or are we witnessing deeper structural shifts? If you step back from the fleeting news cycle and think from a more macro perspective, you would soon realize that China's challenges and opportunities lie not with the U.S., but within itself. The trade war only expedited China's strategic pivot, and at its core, it might have limited to do with Trump's policy. In this video, let's explore why year 2032 could mark a turning point, potentially positioning China to lead the next global economic growth cycle. But to understand the future, we must first dissect the present. At first glance, direct exports to the U.S. constitute a relatively small fraction of China's overall GDP, as previously mentioned. Therefore, the immediate disruption appears limited. However, this doesn't negate the real pain felt by the economy. Even before the recent tariff escalations, China's GDP deflator, which tracks the overall price changes within a country, had been negative for 7 consecutive quarters. This indicates persistent deflationary pressure despite the notable 5.4% GDP growth reported in the first quarter of 2025. These figures reveal more than simple statistical fluctuations. They point to a deeper imbalance between China's extensive manufacturing capacity and mismatched aggregate demand. In simpler terms, domestic consumers aren't purchasing enough goods being produced, so the price keeps spiraling down. Exports represent approximately 20% of China's GDP, which is a significant portion. If American markets substantially reduce their imports, Chinese exporters will need to pivot to alternative destinations. The critical question then becomes, if not the U.S., then who? It's not a simple solution to suggest China can just sell elsewhere. Following the initial U.S.-China trade war back in 2018, China had already begun diversifying its export markets, expanding further into emerging economies outside of Asia. However, many of these newer markets have now also developed significant trade deficits with China. Simply put, the global market has finite capacity, and the U.S. remains one of the most lucrative consumer markets. The only logical solution is clear. China's domestic consumers must absorb more of their own production. As of 2023, household consumption accounted for approximately 39% of China's GDP, while that number was 68% for the U.S. and 55% for Japan. Even at its lowest in the early 1970s, household consumption in Japan was around 46%. Looking at the absolute value, in 2023, China's total household consumption was approximately 6.96 trillion USD, and in the same year, the US figure was 18.82 trillion, almost 3 times that of China. On a per capita basis, US households consume many times more than those in China. This necessity underscores China's critical economic pivot towards a consumption-driven economy, a transformation that is imperative regardless of external pressures such as tariffs. Whether Trump is in power or not, China needs to pivot to find its next growth trajectory. On that front, an analysis by the Morgan Stanley team provides a framework that I find helpful in thinking about this new China dream. According to their study, for domestic consumption to become a main pillar of China's economy, the goal is to increase domestic consumption by 30% by 2030. This translates to about 5.4% annualized growth per year. If China successfully achieves this goal, a 30% increase in domestic consumption would be roughly 3 trillion USD, which Morgan Stanley estimates is equivalent to the reduced import demand from global countries caused by US protectionism. This growth in China's consumer market could create new opportunities, not just for China, but also for export-driven economies in Asia and Europe. Yet, this pivot is far from straightforward. China's massive manufacturing capacity was originally built to supply the entire global market. It's not something that can be quickly absorbed domestically simply by relying on stimulus measures or consumer subsidies. In past decades, a clear global order emerged. Developed markets, particularly the US, consumed while China manufactured. The unparalleled strength of the US dollar provided Americans with significant purchasing power. Every country along the global supply chain has also accumulated wealth during this process. Among these nations, China was by no means the greatest beneficiary of that era of globalization. So now, as global demand plateaus and trade deficits widen, China's biggest challenge is to rebalance supply and demand. And this doesn't just mean China's own internal supply-demand balance, but also the new global trade balance and order. How and when that rebalancing will begin to occur is at core the most important question for China to navigate. From the supply side, Chinese companies primarily pay value-added tax, VAT. From raw materials to the final product, every time value is added during circulation, another layer of tax is applied. This creates a strong incentive for the government to offer various preferential policies to businesses and for factories to increase production, expanding their scale to enlarge the tax base. This was a significant driving force behind China becoming the world's factory and determined that we are a manufacturing-oriented society rather than a consumption-driven one. In the late 1990s, China faced a similar issue, with a large number of state-owned enterprises struggling with overcapacity and losses, forcing drastic reforms that led to massive layoffs. How was this resolved back then? In 2001, China joined the WTO, and this year, the rising global demand is met with Chinese people's hard work. The globalization has heatly unfolded, and China starts to build the world factory capacity. Even 2008 global financial crisis hit, China quickly recovered and resumed the double-digit GDP growth in 2010. 2001 to 2010 was the best years for China, at least from the economic growth perspective. Therefore, in the past 20 years, Made in China was able to continue its previous model, creating a world-astonishing period of prosperity. As Chinese products expanded overseas, global capital also poured into China, especially after the 2008 global financial crisis, as investors sought high-growth markets outside the US, and they profited handsomely. Many of China's greatest entrepreneurs received early backing from foreign investors. In fact, almost all of China's major internet giants have foreign entities as significant shareholders. During this period, Chinese citizens born in the 1960s and 1970s found themselves perfectly positioned to benefit from unprecedented economic growth. They were in their 30s and 40s when this golden era unfolded, the perfect age with life experience, good health, and the ambition to be welcomed into a global village. Incomes were rising, and so were property values, creating a double boost in both income prospects and the wealth effect. Ultimately, China's manufacturing capacity was once built for the entire world. This capacity needs to be consumed, and China's current domestic market simply cannot absorb the production once intended for the globe. So, who is going to consume it? This essentially comes down to the Chinese generation currently in their working age, those young Chinese born in the 1990s and around the turn of the millennium. After 2010, China's double-digit GDP growth gradually cooled down, and when Chinese entered their mature years after 2010, they faced a completely different landscape, property prices had risen to unbearably high levels, placing a significant burden on them. In fact, in China, it's very common for parents to support their children in buying homes. More importantly, most of these young Chinese were born under the strict one-child policy introduced in 1979. They grew up in a highly competitive society, often without the sibling support that previous generations may have had. By 2018, the trade war had begun, and in that year, China's Gen Z had just turned 18. They went through the most competitive schooling in China, where studying over 10 hours a day wasn't uncommon in their childhood, yet they still faced the largest graduating classes and the toughest job market. For instance, 2023 saw an unprecedented 11.58 million university graduates entering an already strained labor market, while youth unemployment rose to a record high of 21.3% in the same year. The supply and demand have quietly become imbalanced. Their parents were exactly those born in the 60s and 70s, but unlike their parents, who saw both income and property values rise, they were born into an era of slowing globalization and a hyper-saturated domestic job market. Now, contrast this with their parents' generation, who were often driven by a strong ambition to accumulate wealth rapidly and didn't shy away from risk-taking. Many Gen Z, on the other hand, prioritize job security and have a more rational, perhaps even disillusioned, view of the potential for massive upside. They understand that merit and hard work alone aren't always enough. You often need economic ties to turn in your favor. On one hand, you'll see the number of people applying for civil service exams rising quickly since 2022. Passing these exams is necessary to secure a job in civil service, which offers more job stability and stable social benefits in China. But on the other hand, according to data from the National Bureau of Statistics, by the end of 2023, China's flexible employment population, or the gig workers, had reached approximately 200 million, accounting for 27% of the national employed population. This also creates vastly different experiences for the generations born in the 1990s and 2000s in China, because not everyone can secure a job at a big company. For most people born in the 60s and 70s, national wealth was far lower than today, but there was a sense that everyone started from the same place with similar opportunities. In contrast, Gen Z is among the first generations in centuries to truly feel the effects of a widening wealth gap. For those entering today's tough job market, whether their parents built up assets during the boom years can make a huge difference. If the family accumulated wealth, the path forward is far smoother. But without that cushion, many young people are left to navigate a much tougher reality. Not coincidentally, China's marriage rate has been declining since 2013 and has not rebounded, and the births per woman have been falling continuously since 2017. This is precisely when children born in the 1990s and early 2000s gradually reached the typical age of starting families. Growing up without siblings might have also placed a psychological weight on individual feelings and ambitions, potentially making starting their own family feel less necessary for some. We've talked a lot about the current challenges, the overcapacity, the pressures on the younger generations. But what if I told you that around 2032, China might be entering a brand new cycle? Back in 2015, China ended its one-child policy. Fast forward to 2032, and the generation born after that change will start turning 18. For the first time in decades, many young adults will have the support of siblings. Around that same year, we're projected to see the number of university graduates start to decline for the first time in China. In fact, we're already seeing the early signs. In 2024, some elementary schools in China have begun to close due to a lack of new students, which is a direct result of the declining birth rates. This trend will gradually ripple through middle schools, high schools, universities, and eventually the working age population. So, the supply side, the number of new workers entering the working age, will not start to peak at least until year 2032. Looking at the demand side, around that time, the generation born after 2010 will be entering society, and their mindset is fundamentally different. The generations born in the 60s and 70s, while they experienced China's most rapid economic growth, also endured immense hardship. They worked incredibly hard during China's initial wealth accumulation, often with low wages and limited social safety nets. In 1978, the average annual wage for urban workers in China was a mere $1,004 USD, only 3% of the US average at the time, and even lower than neighboring countries like the Philippines and Thailand. This instilled a deep-seated habit of frugality in many of them. Ultimately, much of the so-called consumption demand is heavily influenced by marketing and convenience-driven norms. Consider everyday consumption habits. For instance, it's still relatively rare to see Chinese consumers ordering furniture assembly services. It's much more common to assemble it themselves, and the older generation almost never considers things like clothes dryers as necessities. For many middle-aged and older Chinese, saving is not just a necessity, it's a virtue and even a source of satisfaction. They take pride in that. But the kids born after 2010, their parents and teachers are mostly from the 80s and 90s, a generation that experienced China's growing affluence. They didn't live through the Great Famine of the 1950s or the from-scratch frugality of the 60s and 70s. They grew up in an era of improving material and cultural life. Moreover, the 90s and zeros generation were mostly single children, making them more inclined to prioritize personal enjoyment. By 2032, the 90s and 2000s will be the core consuming power, and the post-2010s kids will be entering adulthood as well. Demand is likely to grow. However, like a popular Chinese saying that goes, a grain of dust of an era falling on an individual becomes a mountain. In a sense, the 60s and 70s generation, riding the wave of their time, pre-accumulated the wealth of a generation. The pre-cashed in wealth will eventually need rebalancing, and this rebalancing process can be a completely different experience for each individual. For young Chinese of working age affected by the declining population, whether in real estate, education, or consumption, life won't be an easy transition. Many discuss the ultimate head-to-head between the US and China, but in a sense, the two countries face similar issues. For instance, the younger generation in the US, around 30 years old, has seen significant declines in home ownership, marriage rates, having children, and the proportion living independently. A significant amount of wealth was, in a sense, also pre-spent. And while some individuals and businesses made fortunes during the wave of globalization, that same force that connected the world also led to factory closures and job losses, leaving many feeling disillusioned and left behind. Those workers who lost jobs to machines and Asian factories have just as much stake in this world as those who benefited, and they did nothing wrong in this process, yet the rebalancing period would be tough for them. And it's going to stay tough until this imbalance gets rebalanced and the next cycle begins. For China, that rebalancing process is also unlikely to be entirely replaced by high-tech breakthroughs. China's sheer population volume means it's difficult for one or two cutting-edge industries to drive enough job growth on their own. It's a competition of endurance, how to get through the low point, not just reaching the highest peak. It's a battle of rebalancing wealth and strengthening social welfare systems to help those who haven't benefited as much to get through the economic troughs. And logically, it's easier for a country that already has the manufacturing capability to endure. Once the supply and demand are rebalanced, it's easier to become self-sustaining. So, what about the Chinese Gen Z who are weathering this difficult period? Will they become a so-called lost decade? Not necessarily. We're actually seeing many of them forge their own paths, moving beyond the traditional formula of college degrees and big-name companies. This is partly out of necessity, because a college diploma no longer guarantees a good job, and partly because their definition of success is changing. For them, the meaning of work is decreasing, while the meaning of life is increasing. Their parents grew up during China's planned economy. For many, jobs were assigned, not chosen. Careers were prearranged by the state, with little regard for personal interests or individuality. But for Gen Z, it's a whole new mindset. They're asking, what do I enjoy? What am I good at? What kind of life actually aligns with my values? It's no longer about fitting into the system. It's about building something that fits them. This is the first generation to grow up with real access to the world, watching foreign films, studying abroad, working overseas. They're also among the first to value vibe over utility, willing to pay for stories, feelings, and identity, not just function. And because many of them were the only child in the family due to the one-child policy, their families invest everything in them, financially, emotionally, educationally. That created both pressure and privilege, but it also birthed something new, individuality. You can even see this shift in Chinese names. Chinese people don't use canonical or biblical names, and Chinese given names can carry almost any meaning. For those born in the 60s and 70s, names often reflected collective ideals, like building the country or strengthening the military. But Gen Z names are all over the place, personal, creative, symbolic, or simply a reflection of their parents' good hopes. It's a small detail, but it signals a bigger shift. Success is no longer about enduring hardship for the collective. It's about choosing your own path on your own terms. Even on big social issues like marriage and having kids, many Chinese parents are surprisingly accepting as long as their children are happy. The old dream was about building the nation. The new dream is about building a life that feels authentic. I have written many pieces on how the mindset of the 90s and 2000s generations is creating new investment and business opportunities in China's consumption scenes in my newsletter. If you are interested, you can subscribe to the newsletter via the link in the description box below. Looking ahead to 2032, China will likely be structurally better positioned to start becoming a demand-driven economy. And perhaps a new global economic order could emerge where China increasingly consumes domestically while simultaneously exporting its entire manufacturing ecosystem globally. This could drive regional job growth and economies in other parts of the world, shifting away from the traditional one-on-one dynamic of China selling primarily to developed markets. If you happen to be watching this video in 2032, please leave a comment and say hi and tell us how it's all unfolding.